Stocks and bonds. Firms have several ways to get financing. Getting cash via issuance of new shares of stock, getting cash via issuance of bonds, or retaining profit, that's called auto-financing, or simply delaying payments of suppliers. These last two ways we've studied in accounting, and you may go back to our accounting course if you need to refresh your knowledge of that. So we shall study cash from issuance of new shares of stocks and cash obtained from issuance of bonds. The issuance of shares of stock and of bonds corresponds in both cases, as for any financial products, to contracts between investors and issuers. At the time of the purchase, the investor and the issuer exchange this. The investor gives cash to the issuer, and the issuer gives a contract promising some payments to the investor. The contracts corresponding to new shares of stock and to bonds present some differences. Differences in terms of property, what the investor owns after the contract, in terms of guarantee, and in terms of right. Let's look first of all at shareholders. Shareholders, in theory, are owners of a part of the firm. But if they are numerous, they vote in general assemblies and they are represented by directors. They just receive dividends when the board of directors decide to distribute some. However, if they are numerous, once again, they don't have the right to visit the firm's premises, the plants, the laboratories, and they do not have access to internal detailed information, in particular cost accounting or detailed accounts. So this ownership of a part of the firm is more virtual or theoretical than real. The second way to get cash is to borrow it. So borrowing money. We traditionally distinguish two ways for firms to borrow money: from banks or directly from financial markets, dealing with investors who become bondholders. So we shall not talk about the borrowing from banks anymore. This is what's called intermediate finance. We shall deal with financing without intermediation, that is borrowing directly from the financial markets. Bondholders are entitled to regular payments. They are called coupons. Coupons because bonds used to be pieces of paper from which you would cut off coupons to take to the bank, managing the firm's bond, and get your regular payment. Here's the way a bond looks. This is a kind of bond. Actually, it's something intermediate between a bond and a stock, but let's look at it as a bond. So this is the piece of paper, and these attached to the bond are the coupons. And every quarter of a year or every year, you take one coupon to the bank and get money that is due to you because you were a lender of money to the firm that issued this bond. So the cash flows for you, the investor, look like this. At first, you acquire the bond and paid some money, for instance, 1,000 euros, if that was the price of this bond. And then, regularly, over a certain period of time, let's think of years and to start with, you get coupons. And here, in my example, you get coupons of 50 euros every year, until the end of the life of your loan, if you like, that is of the bond, at which time you get one last 50, and also the so-called face value of the bond, that is 1,000. There are many more contracts. This is the simplest one. Let's turn to some vocabulary. As we saw, there's an exchange of cash for a contract. The agent that gives the cash is called the investor. It's also called the buyer because it buys shares, or it buys bonds as well. And it's also called the lender. On the other side, the agent receiving the cash is called the issuer because it issues shares or bonds. It's also called the seller, and in the case of borrowing, it's called the borrower. Another important distinction is that between primary and secondary markets. A new share or a new bond is said to be issued on the primary market. Whereas once they are in the pocket of investors, these shares or bonds, they can be resold. And it is said then that they are traded on the secondary market. And for bonds, of course, this applies until the end of the life of the bond, after which the bond is no longer has any value. There's a big difference for the firm which issued them. A new issuance of shares or of bonds, that's money flowing into the firm. Whereas on the secondary market, the initial issuer does not receive any money. Yet the firm that issued initially the shares or the bonds, particularly the shares, is concerned with their prices on the market, because in case they have to issue new shares to raise more capital, they will do it at the price, the going price in the stock market of their shares. Therefore, they want their stock price to be reasonably high. Let's talk now about the guarantee. If you are a shareholder, as we saw, the guarantee you have is that you are actually the owner of a piece of the firm. But as we saw, it's more theoretical than real. In the case of a bondholder, that is a lender may or may not receive guarantees while he lent money during the lifetime of his loan. The well-known case is a mortgage on a house. You are a lender to someone who borrowed money from you to buy a house. You may be a bank or you may be an operator on the stock market. Then you will usually receive a mortgage, which is some sort of dead property on the house. And in case the borrower defaults on the loan, there will be procedures at the end of which eventually you could become the actual owner of the house. Raising cash may be guaranteed for the lender also by assets brought by the borrower. There are plenty of cases. This is the case in particular of a type of financial product called repos. Let's finish this lesson presenting some simple and basic concepts with a little bit of history on assignats. During the French Revolution, the government borrowed money, and at the time money meant essentially gold. It borrowed money by issuing a type of banknotes called assignats, and they were intended to become paper money. And they were guaranteed by church holdings taken by the revolution from the church. And indeed, some grand bourgeois later on did become owners of previous church holdings. You may see Balzac's novel Eugénie Grandet to see an example. But what happened during the French Revolution, that there was overissuance of assignats, and this led to the ruin of many smallholders.